What if I told you that some of the biggest trading mistakes don't happen because people misunderstand price? They happen because they misunderstand participation. Every candlestick on your chart tells you where price moved, but it doesn't tell you how committed buyers and sellers actually were. That's the job of volume. Most retail traders focus almost entirely on indicators, chart patterns, or news headlines. Professional traders ask a different question. Who is actually behind this move? Because price without volume is just movement. Volume reveals conviction. In today's video, we're going to cover 10 trending rules I wish I had learned much earlier. These aren't random trading tips. They're principles based on how markets actually function. We'll explore why price and volume must always be analyzed together, the powerful effort versus result principle, how professionals recognize hidden buying and selling using volume, and the 3 volume patterns that often appear before major market turning points. Let's begin. Rule 1. Price shows direction. Volume shows commitment. Imagine you're watching 2 companies release earnings. Stock A jumps 6%. Stock B also jumps 6%. At first glance, both charts look identical, but then you check volume. Stock A traded 5 times its normal daily volume. Stock B traded only half its average volume. Are these moves equally reliable? Not at all. The first move attracted widespread participation. Institutions, hedge funds, mutual funds, and retail traders were all active. The second move happened with very little participation. That makes it much easier for price to reverse. Price tells you what happened. Volume tells you how much the market believed it. Professionals rarely trust price alone. They always ask whether enough participation supports the move. Rule 2. Strong trends need strong participation. Healthy trends almost never grow in isolation. When a genuine uptrend begins, volume usually expands. Why? Because more buyers are entering the market. Demand is increasing. Imagine climbing a mountain. If thousands of people are climbing together, the path is probably safe. But if you're climbing alone, you should probably question where you're going. Markets behave similarly. If price continues rising, while volume gradually disappears, participation is shrinking. Momentum may be fading. That doesn't guarantee a reversal, but it tells professionals to become more cautious. Rule 3. Never judge one candle. One of the biggest beginner mistakes, looking at individual candles without context. Volume only becomes meaningful when compared with previous activity. Suppose today's volume is 2 million shares. Is that high? Maybe. Maybe not. If average volume is 1 million, it's significant. If average volume is 10 million, it's actually weak. Professionals always compare today's activity against historical behavior. Markets are relative, not absolute. Rule 4. Understand effort versus result. This concept comes directly from Wyckoff principles. Think about pushing a heavy car. If 5 people push, the car moves 50 feet. That's normal. High effort, strong result. Now imagine 50 people push, and the car barely moves. Something is wrong. Huge effort, tiny result. Markets work exactly the same way. Volume represents effort. Price movement represents result. When effort and result match, the trend is healthy. When they don't, someone powerful may be absorbing orders behind the scenes. Rule 5. Large volume doesn't always mean strength. Many traders assume high volume automatically confirms a trend. That's not always true. Consider this situation. A stock rallies all week. Then one day, volume suddenly reaches the highest level in months. Retail traders become excited. Financial media celebrates. Everyone wants to buy. But professionals ask, who is selling into all this buying? Often, Institutions distribute shares during maximum public excitement. High volume can signal accumulation or distribution. Context determines the answer. Never analyze volume alone. Always combine it with price behavior. Rule 6. Stopping volume can reveal hidden buyers act. Let's examine our first major volume pattern. Stopping volume. Imagine a stock has been falling for weeks. Fear dominates headlines. Everyone expects lower prices. Suddenly, one day, volume explodes, but instead of collapsing, price finishes near the day's high. What happened? Massive selling entered the market, but someone absorbed nearly all of it. Professional buyers stepped in. Large institutions don't chase rallies. They often buy during panic. Stopping volume frequently marks the beginning of stabilization. Not always, but often enough to deserve attention. Rule 7. Buying Climax. Often looks bullish. Now let's reverse the situation. Price has been rising for months. Optimism is everywhere. Analysts upgrade targets. Social media celebrates new highs. Then, volume reaches extreme levels. Price makes one final explosive rally. Most beginners think, the trend is getting stronger. Professionals think, this might be the final buying wave. Buying climaxes frequently occur when late buyers rush into the market, while experienced institutions quietly sell into that demand. Again, context matters. High volume isn't automatically bullish. Sometimes it's exactly the opposite. Rule 8. Volume divergence. Is the market whispering? This is one of the most underrated concepts in trading. Imagine price keeps making higher highs. Everything looks bullish. But each new rally happens with lower volume. Participation keeps shrinking. The trend still exists, but conviction is fading. Think about applause after a concert. At first, everyone claps loudly. Then gradually, fewer people participate. Eventually, the applause ends. Markets behave similarly. Volume divergence doesn't predict the exact turning point. It simply warns that momentum is becoming less convincing. Professionals pay close attention to these warnings. Rule 9. Case study. Reading what others. Let's build a complete example. A technology stock drops 18% over 3 weeks. News is negative. Retail traders panic. Then one trading session records the highest volume in 6 months. Price opens sharply lower, but finishes near the day's high. Over the next week, selling pressure disappears. Price stabilizes. Institutions were likely absorbing supply. 2 months later, the stock begins a sustained uptrend. Now imagine another example. A stock rallies for months. Volume expands dramatically. Media attention explodes. Retail participation reaches record levels. Then, price barely makes a new high, despite enormous volume. That's effort versus result. Large effort, limited result. Distribution may already be underway. Professionals recognize these subtle differences long before obvious reversals appear. Rule 10. Volume is evidence, not prediction. Perhaps the most important lesson of all. Volume does not predict the future. It explains what is happening beneath the surface. Too many traders search for certainty. Markets don't offer certainty. They offer probabilities. Volume simply improves those probabilities. Instead of asking, will price go higher? Professionals ask, does current participation support this move? That's a much better question, because successful trading isn't about predicting. It's about interpreting evidence objectively. Conclusion. Every market move tells 2 stories. Price tells the visible story. Volume tells the hidden one. When both agree, confidence increases. When they disagree, professionals become cautious. The best traders aren't necessarily better at forecasting. They're better at reading what the market is already revealing. If you start analyzing every chart through these 10 rules, price action will begin making far more sense than it ever did before, because the market rarely hides its intentions. Most traders simply aren't looking in the right place. Thanks for watching. And remember, price tells you what happened. Volume tells you why it happened.